I've given you just kind of an outline of what could be used as a checklist of things that you look at if you're looking at a lease from a tenant's perspective. And so I'm going to touch very quickly and go over these because there can be so many issues and there are so many different circumstances that arise in commercial lease settings. And as I was doing some research for this, you need to understand that Paul is our office's landlord, and there are some things we would like to renegotiate, if that's all right at this point. First, how are premises defined? It's sometimes an innocuous thing. If it's a single tenant facility, that's usually not an issue. But if you have shared driveways, shared restrooms, shared hallways, shared parking, it becomes a major issue. And so you want to know exactly what the premises are and what rights you have with those premises, and that needs good definition so there are no misunderstandings. If you are even in a single facility and you don't define it carefully, and the landlord decides to put up a building on half of the parking you thought you had, it's going to depend on how the lease defined that and what the landlord can or cannot do in that setting. The other issue related to that is square footage. Often commercial leases are based on a square footage basis. And the method of measuring and calculating, there are national standards, but I think every person should probably, before they enter into a commercial lease, go in and self-measure. If you need an expert, those are available, but see exactly what that square footage is as far as you can determine, and then what the landlord is saying the square footage is. You have other resources that you can use for that, and that would either be a city's building permit would typically have square footages, and often the assessor's office will have square footages of facilities and what those are. With respect to common area maintenance charges where there are multiple tenants, this is often an area of some difficulty. For instance, if I were in the Cache Valley Mall and I had a 30% vacancy rate, am I going to have to pick up a share of all of those vacant spaces if a number of businesses go out? Or if as a tenant, I would either like to pay a percentage that is fixed and capped regardless of occupancy, or I would like to put a cap of so much per square foot or so many dollars a month or a year of how much I'm willing to contribute to CAM. Because typically those are things that a tenant cannot control. And if I have Chevrolet tastes, the landlord has Cadillac tastes, we can have some real misunderstandings and difficulties. Typically, particularly because the CAM charges will not infrequently be a third to a half of the rent, you want the right to inspect the books, to review and even audit them if you feel that's necessary. Most people, if they're buying a home, a realtor would tell them, you need to find out what the utilities have been for the last year or two and look at them. You should do the same in a commercial setting. What historically have either utilities been or what have CAM fees been, and then factor that into your budget and whether it's something that works for the business that you're doing. Also, it is well to define what you mean by maintenance for common area maintenance charges. The landlord may think that means resurfacing the entire parking lot. You may think it means just filling cracks, or you may think that you need do nothing with respect to the parking lot, that that's all the landlord's responsibility. So those things need to be carefully defined. For instance, if the landlord hires a manager, is that fee going to be a part of common area maintenance? If the landlord hires an attorney to evict a tenant, is that going to be part of common area maintenance? There are a whole host of things that can fall into gray areas that a lot of misunderstandings are avoided if those things are talked about up front and resolved. If there's some items that should be excluded from CAM, then identify what those are. There also needs to be some understanding of a reconciliation. Typically, for CAM charges, you'll be given an estimated budget for the coming year. You should have an opportunity to review that and see if it's realistic and if the kinds of things that are being included in CAM are appropriate and consistent with your lease. If there are adjustments made in the CAM, how frequently can they be made? Another area that sometimes from a tenant standpoint you would want to do is to say, okay, you set up the budget, but if you go over 10 or 20% or 30% above budget, I'll only pick up this much of that increase because I can't control those charges and how great they may ultimately become. And that's another way of limiting the tenant's exposure. Otherwise, at year end, you run the risk that the landlord did not budget well, has not been telling you what the changes in the CAM charges from actual to budget are, and suddenly you get hit with a multi-$1,000 bill at the end of the year, the beginning of the coming year that you had not been planning on. Those become very, very important and critical items in evaluating, and another reason to probably even have as part of a lease, if the CAM is significant, provisions for maybe quarterly reporting on what the common area maintenance charges are under the budget and what the actuals are to date, so you can track and see how those are coming. Another area is loss, damage, and destruction. Who is responsible for what? There are many triple net leases that are done now with the idea that the landlord has all the rent and no charges that are assessed to that rent. Whatever CAM charges there are, taxes, insurance, everything else is picked up by the tenants. Usually in those situations, the landlord will stay responsible for perhaps structural, roof, foundation kinds of things, but not always. The other area that you often get into issues and disputes with is if you have your own HVAC, you're in a 5-year lease, you have responsibility of maintenance, and it blows out on the 4th year and 6th month, do you have to put in a new furnace? What from a tenant standpoint you would typically like to do is to negotiate provisions so that if there is some kind of a capital expenditure that as a tenant you're going to be responsible for, that is prorated over the reasonable useful life of that so that you don't get hit with the whole thing near the end of the lease. There are always electrical and plumbing issues to consider, and sometimes those are not clearly defined. Anytime the tenant fouls something up by whatever they do, they're probably going to be responsible to take care of it. Likewise, the landlord. But you still want to have an understanding. In some situations, you may want to say, well, we don't want to bother the landlord with nuisance kinds of items. We'll cover anything up to $200 or $500 that's on the interior of our place. But if there's anything above a certain dollar figure, then that becomes the landlord's responsibility. So once again, you limit what the tenant exposure is. I think you would typically want to be named as an additional insured on insurance that the landlord may have, and typically the landlord will ask the tenant, if you're required to have the insurance, to name the landlord as an additional insured on insurance. You typically, subrogation is where to try and explain it briefly, if Dale is the landlord and has insurance, I'm the tenant. We have a loss. I was playing with matches in my space and I caused the fire. Dale had the insurance covers it. If the lease says nothing about it, the insurance carrier is then going to sue me as the tenant because I caused it. I was not the insured necessarily. That's one reason for an additional insured. But a waiver of subrogation is saying, we don't care who has insurance. If you have insurance, that should cover it and leave everybody alone. Insurance companies have been far more aggressive in trying to go after whoever they feel the cause of a loss may be and to try and recoup and limit their own loss. it's important that the landlord or the tenant, both probably, have provisions that indicate you'll get at least 30 days notice before any insurance is canceled. Particularly from 2008 on, it's not been unusual for landlords to be very financially stressed, and insurance is not always on top of the pile and making the biggest demand. If it's canceled, it's canceled. And if a lender isn't tracking closely, that can occur. And then you have a tenant who may be exposed for a loss that the landlord was supposed to insure but did not. You want to also clarify exactly what kind of insurance that it will be. How many kinds of hazards will it cover? And typically the tenant is going to always be responsible to insure tenant fixtures, machinery, inventory that are in their space. But sometimes it may make a difference in terms of what the tenant is responsible for, depending on whether the tenant has interior walls or exterior walls and responsibility for those. Another aspect of, I guess, tied maybe with insurance and with how you define premises. We recently had a case where a client was sued as the landlord for something that the tenant was responsible to do. And so if someone trips and falls in a parking lot, who is going to be responsible? Now, if that is clearly allocated to the tenant, the landlord will usually in Utah not have responsibility. But if the landlord knew about a situation, or there is some way that the lease is not drawn very tightly with respect to that, what happens is the tenant and the landlord both typically get sued for the loss. And if the tenant doesn't have insurance that covers that loss in the parking lot or is responsible for that, then there's more exposure and risk. Parking is often an issue. Typically, landlords want to say, we won't guarantee any number of spaces, we won't guarantee that it's sufficient for your needs, and want to have that as flexible as possible. From a tenant standpoint, what you want to know is that you will have sufficient parking for what your needs are. And if you don't, either designate that you will have so many designated spaces, if that's what you can do, and landlords are not frequently willing to do that, or that they will not involve industries. For instance, a restaurant might have a very high volume at lunchtime that could interfere significantly with the retail business, and then vacate the rest of the time. If there are concerns with parking, either make arrangements possibly with the landlord that employee parking may be designated or placed off premises, or that no one with more than so many employees at any one time in the business will be parking there. But that's typically a critical factor to know that that parking that you have and count on is going to be preserved and adequate, and how the shared use will be handled. Another area that I touched on briefly is if vacancies occur in the building. If you're in a complex and for instance, negotiating a physician lease, I may represent a physician who really wants to be in the proximity of another physician who may refer to them. And so I may want a condition in my lease, if I am the physician wanting the referrals, if this doctor leaves the building, I want out. And you may have other provisions that address that in a lease when you're in a complex with other businesses. If I'm in the insurance business, do I care if my competitor moves in next door in the same space? Or I may want to ask, you're not going to have any competitors to this particular business that I'm in this space. Landlords typically don't like to do that, but depending on market conditions and what you can negotiate, that's always a possibility, and it never hurts to ask. Sometimes if you have significant reductions and you're dependent on foot traffic or auto traffic and conditions change substantially, you may be locked into a lease with no out. Now, over the past years, that has historically happened most obviously in indoor malls, which have been struggling nationally. Whereas if you would say to the Cache Valley Mall that Dillard's and Penny's and another anchor all vacate, are all of the folks that are left still obligated to honor that lease when what they were counting on as part of that lease was some of those anchors bringing in traffic and business for them. So that's another area that you want to clearly address. If the place starts closing up with lots of vacancies, you need to find, hopefully, try and address either how your rent is reduced or how you can terminate the lease in a shorter time than perhaps the entire term that has been set. Rarely are leases recorded. Sometimes notices of leases will be recorded. Lenders typically are not big fans of that, and landlords never like it. But if you have some certain restrictions like no competitor of this type, the safest thing is to have a notice of that recorded. If there's something that you want someone else to know if they were to come into that space, I'm not as much worried about a subsequent buyer of the property as I am a subsequent tenant who has no notice of that limitation. Also, if it's a longer term lease, 5 or 10 years, you may want some flexibility in terms of what kind of business you can conduct on those premises. Your businesses over the course of 10 years may change substantially in what they do. You don't want to become in breach of a lease because there is a change, or you may have an opportunity to sublease to someone who might be in a different business. And again, if your lease is drawn very specifically, this is what you will do, and this is all you will do, then it can really limit your options down the line. At the same time, typically most landlords will say, will typically prohibit any lease or sublease. They want to know who they're dealing with. But if they will sometimes say, you can assign or sublease as long as we approve it. But there are kind of two magic phrases there that can be killers. If we approve it in our sole discretion, they can say, I don't like your hair color, subtenant, I won't allow it. Or you can say in their reasonable discretion, and then they would have to have some kind of a quantifiable or objective standard by which they would have a reason that this tenant would cause them difficulties or problems. Often what landlords want to do when subleasing and assignment is severely limited is make it so that you will either have to pay a substantial fee if you want to assign or sublease, or to renegotiate the lease at a higher rent. Watch closely on when rent is due. Typically it's paid in advance. Often there will be some fairly heavy-duty late fees, sometimes as high as 5 and even higher % if you're 10 days late. I'm not sure that late fees and sometimes substantial interest on late rent. It's fine as long as everyone pays on time, but if you get behind, that really multiplies and magnifies the difficulty and financial stress that a tenant might be in. And typically those are negotiable. And again, a lot depends on the market. If there's a lot of space available, you're going to find landlords more flexible on a lot of these things. If there's not a lot of space available, they're going to say, this is the lease. If you want the space, this is what it's going to require to do. There are often disputes and difficulties on tenant improvements. Typically it's an allowance. The tenant does the improvements, but there become issues. If you're locked into you have 3 months to do tenant improvements, and then the rent starts, and you don't have a building permit yet, and it takes you 3 months to get a building permit, and then the rent starts, and you're still 3 more months away from going in. You want to look at those provisions very carefully. You also want to clearly identify in tenant improvements what items in property that you improve that you can take or cannot take. It's done in homes all the time, and I don't see it done that I'm aware of, and Paul would know better than I. In a commercial setting, you really ought to have a building inspector go in and take a look at the space beforehand and tell you if there's anything that is clearly not working or not adequate or not going to meet your needs. You always want to avoid a personal guarantee if you can, if you're working with a business entity. And again, that's a matter of negotiation between the landlord and the tenant. On the reverse side, I've just indicated some items to try and avoid or at least define on CAM charges and how those are to be handled, because that's kind of the unknown when you lease a piece of a building or warehouse or part of a complex, and that is what those charges are going to be. So in a nutshell, that's kind of an outline of those things to watch for and to help protect a person if you're looking at being a tenant in a commercial lease.
I was intimidated when I found out Miles was speaking with me, and then I saw Troy walk in, and he knows how to build better than I do, and then it summarized when Jack walked in, and Jack knows more about real estate than I'll ever know. My guess is that all of you deal with real estate in one way or another, either as an owner or as a tenant. Somehow you've either owned it, developed it, fixed it, rented it, had a lease, got into a lease, got out of a lease. One way or another, you've crossed that bridge. I wanted to focus just a little bit on types of leases maybe, and Miles covered this very well, so I don't think I'm going to give it maybe as much as I was going to do on the PowerPoint. Really three kinds of leases, if you just put them in big boxes. Your triple net lease, Miles talked about that. Triple net means you pay the rent to the landlord, and he provides the space, and you pay all operating expenses, taxes, insurance, maintenance and repair, all of those things. Landlords typically in a commercial setting will put a triple net lease together, and that's common. The reverse of that is a full service lease, that the landlord pays everything. Just everything that the tenant was paying, now the landlord pays. And that's a very simple lease, so that's a little easier to define, that all you have is rent to pay, and the operational costs, these CAM fees that Miles is talking about, aren't as big an issue because you don't have a CAM fee. You don't have utilities. You don't have maintenance and repair to worry about. You've just got a full service lease there. The reality is, though, most of us from the landlord side and a tenant side don't get either of those leases. We end up with what's called a modified gross. And I went to the internet to find out a good concise definition of modified gross, and I don't think there is one. Which really means it's somewhere in the middle. in that well-defined lease, that one-page document that Miles produces for me occasionally, very occasionally, is a modified gross lease which says the landlord's going to provide this, and the tenant's going to provide this, and we're going to separate out all of these modified gross things. And quite frankly, almost all of my leases are modified gross, even my triple net ones, because a good attorney like Miles will say, okay, let's define CAM, and let's make sure that we're not paying for something that really isn't an operational expense, that is a defect in the building, or vice versa, all kinds of situations like that. So I guess, the upshot of this is that you're probably going to deal with modified gross leases. It might be called a triple net lease, but there really aren't very many triple net leases. We have maybe a few, but most of them are not triple net. We do have more full service leases. I don't know how many of you are renting office space, but a lot of our executive suites, the tenant wants I want the space, and I want to write one check, and I don't want to have to sign up for the utilities, and I don't want to have a CAM fee. And some of our spaces, we're even providing internet service now, that they don't even have to do anything other than show up and have a Wi-Fi connection, and they're in business. And it's a popular thing, and we find that that's a service that works for tenants. So So we provide really a full service lease, particularly in our smaller spaces there. I had just a couple of comments while Miles's presentation is fresh on your mind. Square footage is a big issue, and defining square footage. And Miles' suggestion is a good one. Before you sign the lease, check the square footage out. Don't be surprised if what the landlord says isn't what you would measure if you went from the inside wall to the inside wall, because that typically isn't how square footage is measured. I remember years ago I had a tenant sign the lease, and then when he got in there, took the tape measure and went from that wall to that wall and said, "You've cheated me. There's not nearly as much square footage there as the lease calls for." I said, "Well, I didn't rent you without the wall. I included the wall, and so I measured from the outside, and I measured to the middle of the demising wall, and then I put a load factor to it." And a load factor is an interesting term, but you had to walk down the hall and go out the door, and so you had to pay a percentage of the hallway. And if you think about it, that is really what you're leasing, is the space plus the restrooms and hallway and what's going down there. So anyway, square footage is an important one, and I think the best advice I could tell you is don't get in the argument over what's there or what isn't there. Make sure you understand what's there and what the rent is. The square footage isn't going to change whether the landlord counted that outside wall or didn't count that outside wall, but if you're comparing spaces, make sure that you understand how the square footage was calculated. CAM charges. Again, probably the biggest problem that both landlords and tenants have is over CAM fees. Common area maintenance, and what is a CAM, what isn't a CAM, and CAM reconciliations at the end of the year. And probably there isn't anything in my business that causes more grief is to reconcile a CAM when the expenses went up. And I always try to explain to a tenant, it isn't like I made more money. Utilities went up, taxes went up, insurance went up. Operational costs go up, and because the lease has a tenant paying a proportion of those CAM fees, his rent's going to go up. But Miles's point about defining those CAM fees, I have several of my leases now that we have capped CAM fees, because they don't want to get caught in a situation of the expenses go up, and so we do cap them occasionally. I shouldn't say that, but we do, because sometimes the tenant is not willing to lease space without some CAM to it. Dale mentioned that maybe I ought to talk about what the landlord wants out of the lease. And the obvious thing is the landlord wants rent, but anymore it's more than just rent. We want rent, we want a return on our investment, but the care of those premises, the use of those premises, environmental concerns about those premises, use of the ancillary things, the parking lot, the expectations of all those things that surround the premises are critical. I have a tenant that vacated the space, and in our taking the possession back, we determined there was considerable damage to the premise. And when we spoke to the tenant about it, the tenant said, "No, that's just normal wear and tear." And wear and tear is what you got paid rent for. And early on in my career, I remember going to a small claims court over a residential tenant who I thought had really abused the premises, and the judge leaned over the bench and said, "Mr. Willie, you got paid for wear and tear." And then he leaned over to the tenant and said, "And you get to pay for damage and destruction." And that has stayed with me, that's probably a pretty good definition, that wear and tear is what the landlord got paid his rent for. The building over a lifetime is going to wear out, the carpet's going to wear out, paint's going to wear out, and you got paid for that. And if you cross that line from wear and tear to damage and destruction, the landlord will expect the tenant to pay for damage and destruction, but he can't expect the tenant to pay for wear and tear. And again, it gets a little more complicated than you might think. I had a note or two about how to deal with landlords. Number one, I guess I would say, make sure you have a clear understanding of that lease. I got a call yesterday from one of my partners, Jeff Smart, in Salt Lake, and Jeff manages one of our properties down there. And he said, Paul, I don't get nervous too often when a tenant says they're ready to sign a lease, but he said, I've got a tenant that's ready to sign the lease, and I don't think he's ever read the lease. And he said his agent sent it back to me with a couple typographical changes and a couple of changes to the address and the contact information. He said, but other than that, there were no changes to the lease. And he said, that just leads me to believe that this lease never got read by anybody. And he says, and that might sound great, that, yeah, great, we've got a 10-year lease from a orthodontist that's reputable in the community, a good person and everything, but he said, I'd really like to know that that tenant understands that lease. He said, I think that makes for a better long-term relationship. And so we talked a little bit about, how do we, you hate to go to the tenant and say, you didn't read the lease, and I think I'm not going to sign it because you didn't read it. But I think the basis of good tenant-landlord relationships is to understand that lease, make sure that you're comfortable with it, and that if there are issues, you've at least covered them. If it's a long-term commercial lease, even if it's a short-term, good legal counsel. I'd actually rather have a tenant that has read that lease and has had his attorney read that lease and identified some areas than one who maybe hasn't, done those things. Because I think in the long term it serves us better. Any more leases are framework. I mean, not anymore, but leases are the framework. But as lengthy as they become, it doesn't seem like you can cover all the what ifs and all the alternatives. I think I would depend on that lease. I do depend on that lease, but I'd also look at secondary things to the lease. Is the building kept up? The lease is going to have some language in there about upkeep of the building and who's responsible for this, that, but the very best track record is just walk the building, see what it looks like. What kind of a landlord is that? Does it speak well by what you visually see? And are there issues that are obvious? I guess what I'm saying is not everything's in the lease. Maybe there's some visual things that even aren't in the lease that might be red flags along the way. Let's talk about real estate just as an investment a little bit and why you might lease rather than own, or why you might own rather than lease. Maybe we want to talk about just real estate as an investment a little bit, because like I say, one way or another, you're either going to own it or lease it. And I'm not sure that there is a right answer of whether you should own it or lease it. I know that there are reasons to do both. And as a business owner, that real estate is important to you. It will add to your business, or if you own it as a landlord, it will contribute to your cash flow. And maybe understanding that landlord side of the equation, because you probably all are landlords in one way or another, even if you're a long-term tenant. Simple reasons to own in real estate: cash flow, inflation, tax benefits of depreciation, and some non-monetary reasons to own real estate. Pride of ownership, comfort, convenience. You can paint it, you can do what you want with it, it's yours to do something with. We always look at the cash flow, and I'll talk a little bit about the cash flow of real estate as being the primary reason to own real estate. But I've almost come to the conclusion there are more reasons than just cash flow to own real estate. Somebody said, don't wait to buy real estate and then wait. And that really is kind of the axiom of real estate. Almost every piece of real estate that Jack or I have ever bought 40 years ago is worth considerably more today. And it isn't any of our genius that did that. We live in inflation. And over 5 years, 10 years, 20 years, 30 years, 40 years, real estate goes up in value. So probably the reason to own real estate is it's the hedge against inflation. It probably will outpace inflation. Let me talk a little bit about some terms to talk about when you invest in real estate. Net operating income is pretty simple. Everybody understands that one easy enough, I think. That's all your operating income from various sources less your expenses. It gives you what we call net operating income. It's kind of a standard term that we look at. And from net operating income, you can derive capitalization. And capitalization is simply the amount of capital that you have into the property, and then take the net operating income and divide the capital into the net operating income. And it'll give you a percentage, 10%, 7%, 12%, whatever. If you've got a $1 million investment, total $1 million, and if it produced you $70,000, that gave you a 7% return, a 7% cap rate. And we've watched cap rates in the last few years go down, 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 down. I never thought that I would be looking at cap rates in the 5s and 6s. In most of my career, Jack could confirm with me that we've been talking 9s and 10s and sometimes 11s and sometimes 8s, but never 5s. And why would you buy real estate with a cap rate of 5? But we're doing it. We're developing real estate, apartments and things like that. We're looking in the 5s and the 6s, which is kind of unheard of. And then cash on cash, a lot of I'm old enough now, I get to hire some of these young kids that are a lot smarter than I was. I've actually interfaced with a couple that have gone to MBA and have a real estate MBA, and they're pretty smart. They can run spreadsheets, about 5 miles long. They can analyze that thing for 50 years, and they're fairly accurate, actually. But in my career, I've kind of reduced it down to about 4 things that I'm interested in. I'm interested in the net operating income. What's the gross income? What are the gross expenses? And what's the net? I'm interested in the cap rate. And I'm interested in cash on cash. Cash on cash is interesting because what that is saying is I put in X amount of cash, and what's my return on my cash? As you know, in a $1 million investment, let's assume that I think I've even got a slide maybe on this. Maybe I do. Let's just see. Yeah. If you have a $1 million investment, and this is real simple to keep our numbers easy. If you're returning $70,000, that's a 7% cap rate. And if it was all my $1 million, which never is, but if it was all my $1 million, I would be getting a 7% return on my investment. And that's not too unheard of. But the reality is, most of us go to a bank or someone, and we put $300,000 of our cash into it. We put $700,000 of loan into it, and today, and only in the last couple of years, you can borrow that money at maybe 4%. And so that cost of funds is $28,000. And remember that my total return was $70,000. And so the return on my cash is $42,000. And again, I'm keeping the math real simple here. So what I'm really getting is a 14% cash on cash, which is a pretty high return. And it is simply a matter of leverage, of borrowing money cheaper than the investment is returning it. The investment is overall returning it at 7%. I'm borrowing bank money at 4%, which means I'm getting a 14% on my money. And all of you in your various situations can run that analysis. Whether you're buying real estate or whether you're investing in your business, It's the reason we love banks. It's the reason we love banks at 4%. People ask me, why are you still doing this? And my honest answer is, I'm doing it because interest rates are so cheap right now. I honestly thought by now I'd, be on a mission or doing something different, but I'm going to do that when the interest rates go back up. As long as interest rates are at 4%, we ought to be investing in real estate. And I'm not sure if I have anything else here worth showing you. And maybe we should. Here's the reasons that people buy or rent real estate: is it takes less capital, and Wasatch. When I affiliated with Wasatch, James remembers this when we were down in the old Logan Savings and Loan Building. Wasatch leased there for 12 years, maybe longer than that. I don't know. It was a long-term lease, and Deloitte, wisely negotiated a long-term lease at a low rent, and then sublet quite a bit of it out, and ended up that the cost was almost nothing. So it isn't like landlords only own. Wasatch, who's probably one of the successful real estate companies in Logan, leased for at least 12 years down there. So I wouldn't say you always need to buy. Ties up less capital, more flexibility. Rent is deductible. Interest is deductible also, but rent is 100% deductible. Principal is not deductible on a mortgage payment. Less management responsibility and less diversion of your core business. I don't think we have any doctors here, do we? I don't dare tell doctor stories, but I'm always a little bit amused when doctors are insistent that they own real estate. And I think, if I could make the hourly wage that they're making, why would you even want to mess with fixing the toilets and, cleaning and maintaining and repairing? Just do what you do very well, and you don't need to own real estate if you can make the kind of money that some people can make. Like I say, I've got to that point in life. Sometimes owning less is more. And of course, the reasons to own are pretty obvious. An appreciating asset, we've talked a little bit about that. Inflation. You can control your occupancy costs, and it's hard to control them when you don't own the real estate. The tax benefits and the cash flow. Anyway, I think in summary, my synopsis is: read the lease, understand the lease, understand CAMs, understand CAM reconciliation, understand what the landlord is expecting of that lease. Don't go into it assuming that we'll work that out later. The time to work that out is probably right now, and even from a landlord standpoint, I'd rather have the discussion and work that out now than I would get you into the space and find out you can't make the rent payments, and now we're both pregnant, and what are we going to do? Because I have invested, I have all kinds of history that tells me just signing the lease isn't really what I want out of the deal. I want a viable tenant that can perform on the lease, just not a tenant that's in there. And I think I'll conclude and save the rest for questions maybe.
Bankers like to be assured they know where they're going. They take a lot of risk. It's difficult to get their money back when it's a loss situation. So they like things well defined. And as a business owner, a lease gives you the opportunity to define your occupancy costs. And it helps your banker understand what those occupancy costs are going to be. There's a couple of things on the leases, and I would emphasize this from the get-go. Until a lease is actually signed, it's still negotiable. And just because a landlord presents to you a 35-page lease, read it, understand it, and you don't necessarily have to agree with everything he has. And he wants you to sign the lease so he can get his rent, but he's asking everything on the landlord's perspective to protect himself and his property to every possible extent of the law. As a tenant, You have the responsibility to protect your business and make sure that the terms of that lease allow you enough flexibility to conduct your business and make it profitable for you. So read the lease. If there's something that you can't live with, something wrong with the CAM, something wrong with the parking lot, something wrong with subletting it, mark it, highlight it, go back to your agent or your landlord and say, I can't live with this, let's change it. Maybe he'll say, well, that's okay, we can change it, we can compromise, or no, we can't, that's a non-negotiable item. And I own the building, if you want it, you have to accept that item. And then you have to make that decision whether you need to accept it or not. Leases can affect your banking relationship. There's one lease that I read for a prospective tenant that required that this tenant pledge all of the equipment, personal assets that they were putting into their business as additional security on the lease, which in essence gave the landlord a first lien position on all of her equipment. That may be acceptable to the tenant, but if she has to go to the bank and borrow money to acquire that equipment or get an SBA loan, she can't do it because she can't give the security position. If she just gone ahead and signed the lease, it would have been a problem. So read the lease, understand it. For most landlords, there's probably not really an absolute requirement they have a first lien position on your equipment to guarantee the lease. What are they going to sell it out for junk? It's kind of academic. Review it. We talked a little bit about partial building strip malls. This is an area that you need to be careful and make sure that you understand that you're well covered there. As you mentioned, maybe you'd require your business needs to be open on Sunday. Maybe the mall says we don't open this building on Sunday. You got a conflict. You got to make sure that you have compatibility between what the mall's rules are and what you have to do. Another thing that's very critical to a tenant is what Miles touched on, is if you have a shopping center or an office building and you're depending upon that particular building attracting customers to your business, then all of a sudden the building is partially empty. 550 North Main might be a prime example. That building that was turned into multiple partial little businesses. If you're in that building and you expect traffic to come, and then all of a sudden it's got a 75% vacancy ratio for whatever reason, your business might suffer considerably. So be careful and understand what happens if you require a certain percentage of occupancy in the building, in the lease. Be sure that you and the landlord understand that and that you don't get into that. You don't need a banker to get a lease. Banker's just part of your team and your business, and they're just an advisor for you. Just an advisor. Same as your CPA. No. If you're borrowing money, if you got some loan obligations, some SBA loans, they want to know what the terms of your lease are. But if you're not, you don't need a banker. But I tell people that in your business, you need a banker, you need an attorney, you need a CPA. At least those three as advisors. Pardon? Oh, insurance too. But you need some help there just for people to go to answer questions for you. Hey, well, thanks for coming, and again, thanks for our presenters. I appreciate their time and efforts.